Good to go.
Welcome, everyone. My name is Sarah Crymans, and with me I have Nikki Johnson, and I'll be introducing her in just a little bit more detail here in a minute. But we're so pleased everyone is with us today on this Tuesday after a Monday holiday. So we appreciate that. Thanks for everyone that's been sharing in the chat. If you haven't had an opportunity to, go ahead and share where you're joining from. And what are you most concerned about related to your credit score and credit report? So take time to do that. All right. So I think we're going to just have you share in the chat here. Correct, Nikki? We're going to do a chat on this one rather than a poll. Why are you participating today? Let us know if it's for personal use, professional use, or both personal and professional. Why are you participating? Personal, personal, personal. Great. Okay. Lots of folks here for personal use. Good deal. Great. Looks like the majority of folks are participating today for personal benefit. Yeah. Thank you for sharing. You can continue to respond in the chat there if you haven't already. So as I said, my name is Sarah, and I'm an extension educator located out in West Central Minnesota, located in Morris, co-located with our West Central Research and Outreach Center just off the Morris campus. And Nikki Johnson, we share with NDSU Extension. And so Nikki has a strong background in health and nutrition and is working on building knowledge and expertise in the personal finance area. So she's my partner today. So I'm happy to work with you, Nikki. All right, and with us today we have Diane Seafelt, and she's located up in Duluth. She's with our U of M Extension as well, and she's going to serve as our webinar producer today. So if you have any tech issues, feel free to send a private chat to Diane. She'll be helping us monitor the chat box, and she'll be putting a few links in the chat, primarily the evaluation link at the end. So thank you, Diane. And I wanted to welcome Lauren Johnson, who is one of our new regional support staff who's sitting in today and will be helping us more in the future. All right, so today, whoops, I'm going to go back one. Happy clicker here. Oh, there we go. Okay, today we're going to look at credit scores. We're going to look at credit reports, and we're going to identify some ways to build your credit history. So some of the things that we saw in the chat earlier on will be addressed in those areas. So we're excited about that. Okay, so what is credit? Here we go. And I'm going to click to get these to come in, I think. Here we go. So credit is the ability to borrow money and repay it later. So if you say, I've got credit, it means that you have the opportunity, or someone believes that you're a good risk that they would loan you money. So the ability to borrow. If I click in the right spot, we'll do well here. There we go. Debt is the money that you have to repay when you've used credit, right? So the debt is the amount we need to repay. And then I think we have one more on this. So you can have credit available to use without having debt. But we do need to at some point demonstrate that you are a good risk and that you've been a good user, a good consumer of credit products in the past. So I think, Nikki, I'm going to pass it on to you, I believe.
Sure. So let's take a look at what credit really is. So when you take out a credit card or other loan, you are creating your credit history. And sometimes when people talk about their financial situation, they say that they have, good credit or bad credit. But this oftentimes means that they're really referring to that credit history. Credit reporting companies are going to then gather information from your credit history into a credit report. So a credit report may show some of your bill payment history, along with some public record information and a record of how often you have applied for credit. A credit report may also show how much available credit you have, how much of that credit you're using, and whether you've made payments on times, or whether or not somebody's trying to collect a debt that you owe. The information in your credit report is then used to create credit scores. So you can kind of see how use of credit plays into that credit history, which is then compiled into a credit report, which then is used to calculate credit score. So it all is intertwined and interconnected.
I really like this graphic, Nikki. Earlier on, Melissa shared that she's never had any credit cards and so is really sitting with no credit history. So for her, she's starting over on that left-hand side and will need to maneuver her way through, right?
Absolutely. So let's just do a quick, one versus the other here, right? Because sometimes the terminology gets a little bit tricky. So a credit report versus a credit score. A credit report is really a record of your history of managing and repaying debt. And it kind of works like a report card to lenders and other companies. And they look at these when they're deciding to do business with you. Included in your credit report is a historical record of how and when you pay your bills. Again, how much debt you have, how long you've been managing accounts, and all that information is compiled by credit bureaus from different merchants, utility companies, banks, and other creditors about your payment history. Now, your credit score, on the other hand, is really an indication of your credit worthiness. And this credit score is a 3-digit number based on the information contained in your credit report. Okay. And that's going to be something that the lender uses to kind of help them determine whether or not they're going to grant you credit and at what terms. So with that, why do you think, go ahead and add in the chat here, but why do you think credit reports and scores matter? We'll give you a couple of seconds to think that through and add into the chat. But why do you think this is important? Okay, they can help you to determine if you'll get a loan. Right? The lender wants to find out whether or not they're going to get paid back. If they're going to loan this money to you or give you this line of credit, how likely is it that they're going to get paid back? Because we live in a capitalistic world. Other thoughts? I can keep letting you add. Use it as a barometer for your overall responsibility. Ooh, I like that description there. Yeah, there's going to be a lot of reasons actually why those credit reports and scores matter. And here is just a list. But there's at times people think that maybe credit reports and scores don't necessarily matter because they never plan to get a loan. However, the information on your your credit report is also used to make a lot of other decisions about you. So a poor credit history can make it difficult for you in a lot of different arenas. There's just a few things listed here. So a potential employer might use your credit report to determine whether or not you get a position. Now, little disclaimer there, know that if they are looking at your credit report for a position, they do need your consent in order to look at it. They can't just pull your credit report and say, no, you don't get a job. You actually have to give them consent. In military positions, sometimes a credit report is looked at to say whether or not you've got that, or whether you can get or keep security clearance. Landlords might use your reports or scores to determine whether to rent an apartment to you. Again, they need your consent, but it might be something they would look at. Same with insurance companies. That might depend on the state that you live in. It might also affect your deposits and utilities and give you better terms on cell phone plans. Credit reports and scores can matter be about or for credit cards, excuse me, whether or not you get a credit card, what that limit looks like, your rate. And of course, credit scores are going to matter, or excuse me, reports are going to matter because that information is used to calculate your scores, right? All of that is coming from your credit history. So if any of these things are important to you, improving your credit history can really help you to get them. Having that positive credit history and good credit scores can open doors for you. And having a poor credit history or a credit score can create obstacles. But just know that if you're in that boat, maybe where your credit history and score isn't quite where you want it to be, Sarah and I will be talking a bit about how you can improve upon that. So let's take a look at credit reports here. A credit report, again, is really that record of your history of managing and repaying debt. And it's a really important component to your overall financial wellness. Knowing what's on your credit report and monitoring your credit report to ensure that all of the information that's on there is accurate. So in your credit report, there are 5 sections of information. We've kind of got this header with all of your identifying information. We've got public record information. We've got collection agency account information, and then inquiries made to your account. So let's look at each of these sections just a little bit here. So in your credit report in the header, you're going to see some of the basics: name, address, social security number, date and place of birth, as well as your employment history. Now, in your employment history, it might not include every past job that you've ever had, but whatever is listed on your credit report employment history should be accurate. This section does not include, however, any information on like race or ethnicity, just the information listed here. And as I kind of talk through each of these sections, I know we'll talk a little bit about errors, but it's always really good to make sure what's ever listed here matches your information to the T. The next section is going to be the public record. So the 3 nationwide credit reporting companies are required to ensure that any new and existing public record information that they use comes from sources that include specific information about you. So things like those bankruptcies or potentially tax liens, that means it has to match that public record information has to have all of the information about your name, your address attached, your social security number or date of birth. And that's to help ensure that the information is accurate. And typically the credit reporting companies are going to update this information every 90 days. Now, what was really interesting about this little section on public records and those financial public records is that we saw some information that was maybe changing a little bit. For sure, you're going to see those bankruptcies on your credit report. And those can stay on your credit report, I believe, for 7 to 10 years. But the tax liens, sorry, typo there, tax liens, there was a little bit of discrepancy. So prior to 2018, these definitely were found on your credit report. But depending on the state, as well as some of the information that's tied to that lien, it may or may not be included on your credit report here. Included on your credit report, you're also going to find collection agency account information. So this is going to be any account with a collection agency. And this is going to happen when an account becomes seriously past due, right? Where a creditor might decide to turn the account over to a collection department and then sell it to a collection agency. Once an account is sold to a collection agency, that collection account can then be reported as a separate account on your credit report. And these can have a very negative impact on your credit history and your credit score. And collections can appear from a variety of accounts, such as unsecured accounts like credit cards or personal loans. Now, one thing to know is that debt collectors can take certain steps or need to take certain steps before it goes to our credit reporting company. So this doesn't immediately, once a collection, say, goes to the internal department, it's not necessarily going to end up on the report right away. They do have to go through several steps, like contacting you on the phone, via mail, before it gets turned over to a collection agency and ends up on your credit report. They're also going to look at your credit account information. So this is going to be looking at all open accounts that you currently have, as well as closed accounts that you have. This section of the credit report is something that I found to be very interesting the first time I ever looked at my credit report. I was kind of shocked at how many different accounts were listed here. You know, things like credit cards, mortgages, auto loans, student loans. And I can just say that in my short life so far on this earth, I've had a lot of different cars and and car loans and student loans. So it was interesting to see that all of that listed on paper or on an electronic copy. But they're going to give all of the information about that particular credit account. And they're also going to look at things like the credit limit. They're going to list on there the date that all of these things are reported. They're also going to make note on there about amounts that are currently owed and if you're late with payments and the balance is due. So for example, I currently have an open car loan out, right? They're going to show, it's going to show on there exactly how much money I still owe. There's also going to be indication on the credit report whether you owe a past due amount and how many payments, or the number of payments and the days late that you are. They also will make a note on there whether the account was charged off or deemed so delinquent that the creditor thinks it's unlikely that they will be able to collect the debt. And it's also good to know that some accounts might not be listed, especially many older accounts or ones that you've closed. But just, it's important to note that accounts for which the information on there is correct, and that they belonged to you, especially if you have a very common name like Johnson, making sure it belongs to the correct Johnson. And then finally, the last little piece here on your credit report are going to be inquiries. There's a couple different types of inquiries that can be made. We've got hard inquiries and soft inquiries. Hard inquiries are made by lenders after you apply for credit, and these can affect your credit score. And this is because most credit scoring models really look at how recently and frequently you've applied for credit. These hard inquiries remain on your credit report for up to 2 years. But as long as you're keeping up with payments, oftentimes your credit scores rebound from an inquiry within just a few months. And even some credit scoring models won't look at that inquiry past 12 months or so. A soft inquiry, however, is going to be a review of your credit file when you're not seeking to establish any new credit account. This might be a review of an existing account by lenders. It might be pre-screening inquiries by prospective lenders. And this might also be when you are requesting your own credit report. So when you are just kind of doing a review of that credit file, it's going to be that soft inquiry, and that's not going to change your credit score at all.
I think it's interesting to think about the hard versus the soft inquiries. And if you are in the market to purchase a new car, or you're shopping for a mortgage, or in Minnesota, you're going to get a new boat for this summer, whatever it might be, if you're shopping around, it's really recommended to do that intense shopping within a month or two, as opposed to shopping all year long and, going to different car lots or boat lots or whatever it might be, because it shows that you're indeed looking at purchasing perhaps, but shortening that shopping window rather than having it all year can really make a difference as well. All right, so we're going to go to the next slide, and we have a question here. And somebody talked about errors, that there's a lot of mistakes in credit reports. So, what types of errors might show up on a credit report? Go ahead and share your thoughts in the chat. And if you haven't found the chat yet, it should be located down at the bottom of your screen with a little word bubble. Identity theft, fraud, right? Someone got a hold of some of your information. Definitely. Thanks, Kyle. What other kinds of errors might show up?
I know for me, I had an account for a utility company and an address that was not mine. I had a different Nicole Johnson's utility company information listed on my credit report that I had to work on getting fixed.
Oh, wow. Yeah, so it wasn't yours. Emmett says that his report once said he didn't have high enough credit amounts, which really wasn't true. So are you saying they didn't have that accurate number for your credit limit, perhaps? Melissa had a bill that was not hers. Nikki, you talked about being a Johnson. I have a coworker who's an Olson, and she had a college, not a roommate, but someone who graduated the same year in college from the same institution as her. Same name, their middle initials were different, and their social security card numbers were off by one number. And this other Olson did not manage finances very well. So throughout my coworker's life, she has had to really monitor to make sure this other Olson's information didn't show up. Well, thanks to those of you that shared. We're going to take a look here. Yep, Melissa also shares identity theft happened. Oh, as well. Was in Colorado filed taxes under your name. Wow, from another state. Yep, yikes is the, the right response on that. It's important for us to know what's going on there. So here's some of the common credit report errors. So identity errors. So anything about your identification. So maybe wrong name, phone number, address. We want to make sure that that is accurate. Also, you want to make sure that all the accounts listed belong to you and not to someone else with a similar name. So this mixing of two consumers' information in a single file is called a mixed file. They've got a name for that, and we don't want mixed files. We want you to have ownership totally of what's in your credit report. Also, incorrect accounts resulting from identity theft, and folks shared that. The second type of error could be incorrect reporting of account status. So maybe you closed some accounts and they're still showing that they're open. Or it could show that you are reported as an owner of account when you might be just an authorized user. It could be that accounts are incorrectly reported as late or delinquent. So if you've been paying on time, we don't want that negative information to show up on those accounts. And sometimes debts might be listed a few times with different names or slightly different names, and we only want those debts to show up once. Then the data management section, or there might be data management errors. Again, with reinsertion of incorrect information after it was corrected. It could be accounts that appear multiple times with different creditors listed, especially in the case of delinquent accounts or accounts in collection. So is the collection agency reporting on them? Is the original creditor reporting on those as well? And then balance errors. So they may be reporting incorrect current balances, or that incorrect credit limit. And someone had referenced that in the chat as well. So it's important to read the details, know what's in there, and do a quick comparison to what you believe should be in the report. So how do you fix those errors? Well, definitely connect with that credit reporting agency, dispute the information. And so contact that credit reporting agency. Also contact the company who provided the information. Do this in writing, and keep copies of the letters that you send. So if it's an email or a letter, make sure you keep copies of those. And if you're sending proof that, for example, I paid off that car loan a year and a half ago, you want to include in that the statement that shows that car loan was paid in full, and always send a copy, not your originals, with that. So connecting both with that credit reporting agency and the company that provided the information, and it's really a good idea to get after that sooner rather than later, because we know that credit impacts so many different things in our lives.
I was just going to say too on that. I just recently have had to do this with my credit reports. As I mentioned, I had somebody else's information on my credit report. And right away, I felt like it was going to be a really daunting kind of situation. Like, oh my gosh, this is going to take so long for me to be able to do. I was feeling a little nervous about it. It actually was a fairly painless process to get those errors fixed. Each of the credit reporting agencies that Sarah has listed here, I've contacted all three of them, and I've actually done it in 3 different ways. Some of them, they have an online version where all of the copies are sent electronically into your email. I've actually done the letter one too. They've got those email templates on each of the websites, which are really fantastic to kind of be able just to plug in your information. But I've made phone calls as well. And like I said, it's a pretty painless process, and they will send you the copies of the information that you need once those pieces are corrected. So I just wanted to put that little bug in everybody's ear. It's not as scary as it might initially seem if you find an error.
Thanks for sharing that, Nikki. Emmett's asking, is email or letter better? I think either is fine. Just the fact that you're reaching out, and especially if they've got those online, contact us or report an error type of feature on the website, go ahead and do that. Again, keep copies. Nikki indicated she talked with folks on the phone, so I would take a notebook or a tablet and keep track of what day did you call, who did you talk to, and what was discussed and what was decided. And by law, they need the credit bureaus need to investigate your claim that there's incorrect information. I believe within 60 days, and then they need to get back to you on oh yes, you're correct. So sorry, let me fix that error. Or they might come back and say, no, we really found that you do owe this much money, and it's going to stand. Right. And I believe we might be talking about here in the next couple of slides, I'm not sure, that if you still dispute or disagree with that, you can put a note on your credit report, and to give your side of the story, if you will, on why you believe the information is incorrect. So there's an opportunity to have the last say, even if it doesn't get taken off. So these are the 3 main credit reporting companies: Equifax, Experian, and TransUnion. And so you were able to get a free credit report from each of the 3 nationwide credit reporting companies once every 12 months. Now, some people choose to stagger these across the year so that they can kind of keep a handle on things. So they might get Equifax now, 4 months from now, they'll grab Experian, 4 months from then they'll request TransUnions, and then the year starts over again. So we do that. And so that's a nice way to monitor across the calendar year. Now, do know that your reports are not going to be exactly the same from each of the 3 credit bureaus. And that's because not all creditors will, or not all creditors need to report to each of the 3 reporting agencies. So do know that there's going to be some differences there. But so you can stagger those if you choose. Let me see. There are other times that you can get additional free reports. So if you're unemployed and plan to look for a job in the next 60 days, if you receive public assistance, if you believe your credit file is inaccurate due to fraud, if your credit has recently been changed due to a disputed error, you can request an extra copy. Or if you have a consumer reporting company that places an initial fraud alert on your credit file, or if there was an extended fraud alert on your file, or if you've been denied credit, employment, or insurance because of information in your credit report, you have 60 days to request your report from when you received that notice. But you must request those reports. It just doesn't show up for you. You need to request those. Emmett, you're correct. The soft inquiries do not affect your credit score. That is true. All right, so a few extra tips here. So if you print out or if you receive your report online as opposed to in the mail, save a PDF of that report, print it off, or both. It's good to keep a copy of that. And of course, be sure to do that in a safe, secure location, and try to avoid doing that on public computers such as the library, or make sure you're totally logging out so nobody can access your information. So we are going to jump into credit scores. And I was just reading that fine print. I need better readers too, Nikki. So I think you're going to talk about credit scores.
Yeah, so credit scores, just a little refresher again. So our credit scores are going to be calculated using all of the information that we just talked about that you would find in those credit reports. Okay, and that's why it's so important to review your credit reports to make sure all of the information is accurate, because that's what's going to be used again in creating this score. Now, credit scores can vary simply because, as Sarah mentioned, different companies might look at different information, or different things might be reported to different credit agencies. In addition to that, they might use different formulas for calculating scores. Scoring companies might also create different credit scores that are used when you apply for different types of credit. So as a result, you have more than one credit score, which I know can be a little bit tricky, but we'll talk a little bit more about these scores. But one thing that we do know about scores is that a higher score is going to make it easier to qualify for a loan, as well as lower interest rates. So thinking about that, we've got another question for you that we want you to add into the chat. What factors then do you think are going to affect a credit score? We've already mentioned some, but what do you think is going to affect your credit score? Okay, whether or not bills are paid on time, number of lines of credit open, good, amount of debt, debt to credit card limit, yep, so that credit utilization. I'm just reading too fast. Credit utilization, you guys are all on the same page here, great. When you have credit and you're not using it. Good, yeah, we're gonna look at a lot of these different factors to kind of see how they fit into a credit score. And specifically, we're going to look today at the FICO credit score. So not all credit scores are FICO scores. However, FICO scores have kind of been the industry standard for determining a person's credit risk. And currently, more than 90% of top lenders use this FICO score to kind of make faster, fair, and more accurate lending decisions. Other credit scores, I should just kind of point out, can be very different from the FICO scores, sometimes by even as much as 100 points. But again, the majority, about 90% of those top lenders are going to use the FICO score when thinking about lending decisions. And to kind of get us thinking about that, there's a quick little, oh, I was worried it wasn't going to play for us. That's what happens when things move back and forth.
I wonder, Nikki, if you want to grab the link and you could put it in a new web browser
I
window.
absolutely will.
Yeah, we'll take time to do that because I know it's a nice
It's
Nice
a
video.
great video. Yes.
Yeah. So while you're doing that, I was just responding in the chat to Heidi, so I'll stop typing there. Heidi said she was once told that it can hurt your credit score by having a credit card and not using it. And I'm don't totally agree with that. So I think not using a credit card isn't going to hurt you, but if you have no behavior or activity to demonstrate that you're a good risk, that could hurt you. So if you have a credit card and you're not using it, but maybe you have a mortgage and a car loan that's demonstrating good behavior, then you're probably okay. But if you have no activity to demonstrate good behavior, then there could be a problem. How you doing with that, Nikki?
I'm good. I'm just pulling it up right now.
Perfect.
I'm going to do a new share. So
great.
Let me know if you can see that video on the screen.
Yes, you'll want to enlarge it, but it looks great.
Perfect. Why do you need to understand what a FICO score is and how it's used? Because it's the credit score most commonly used by US lenders. Every day, thousands of lenders use it to more accurately understand your credit risk and make more well-informed credit granting decisions. In a nutshell, the FICO score is a number that predicts how likely you are to pay back a loan or other credit obligations in a timely fashion. The FICO scores are calculated from the data in your credit reports housed at the 3 main credit bureaus. The scores consider information about your payment history, use of available credit, plus other factors. Most of us have FICO scores for each of our credit reports. Of course, if you don't have any recently reported credit history, you won't have a FICO score. FICO scores are dynamic and can change up or down if and when your data at the credit bureaus changes. And they're calculated in real time, so they're current as of the time you or a lender requests them. FICO scores generally range from 300 to 850. The higher the score, the lower the risk for the lender. Ultimately, your FICO scores are in your hands because it's based on your credit habits as captured in your credit report. Your FICO scores do not determine whether you're approved for credit or what interest rate is assigned. That's up to the lender. But it does help the lender make that credit granting decision. So why do FICO scores matter to you? First, it makes the lending process faster and more fair. It provides you with more credit choices at competitive rates, and you'll get faster answers from lenders since the scores streamline the application process. And it applies the same set of standards to all borrowers. Finally, as you prepare to apply for a loan and view your own FICO scores, you can see what a lender sees. Your credit history all rolled up in a 3-digit number that predicts your likelihood to pay your bills on time.
Nice video. While Nikki gets back to her screen, does anyone have any questions? Abigail does. Should you close a credit card you are no longer using? Aha. It depends, right? So is there a reason you're not using it, right? It maybe the interest rate's too high, or you just haven't needed to use it. But if it's a card that you've had for a long time, you get kind of, I don't know if they're bonus points, but it's smiled upon positively if you've had a long-term relationship with a credit card. But if you have a fistful or a wallet full of credit cards that you aren't using, I would close them slowly and keep just a few that you use more currently. Nikki, what is a FICO score? What does that stand for?
I was just looking that up.
The trivia question of the day.
It stands for the Fair Isaac Corporation. And he was a pioneer in developing the method for calculating credit scores. I didn't know that until today. Great question, Charisse. I guess I never even wondered why it was called that. Oh, I love it. So I will say that the FICO website does have some fantastic, really brief 2-minute videos like you just saw there. I can't even tell you how many of them I watched. I was like, oh, this is just a nice little summary of this particular question or this particular topic. But so the credit score, I know they kind of explain this in the video, but sometimes it's just nice for me to be able to see that visual. And I thought maybe all of you are the same way as I was there. So credit scores, right, are calculated based on that information in your credit report. And while different credit scores have different mathematical formulas, they're going to use all the information from your credit report. Some pieces of your information in your credit report might be more important or less important, depending on which company is really calculating your score. But the key is to understand that information in your credit reports. So as far as our FICO score here, we've got several categories that are going to influence your score. So we've got payment history. So this is going to track whether you're paying your bills on time. And this is the biggest factor in your FICO score. So you can see 35% here. So paying your bills late, not paying your bills at all, or having bills that go to collections will likely cause your scores to drop. However, paying those bills on time may help to increase your score. We're also going to look at amounts owed. Those are going to be tracked on what you owe. So including debts that you're currently paying down over time. It's also going to include your credit utilization rate. So a couple of you mentioned that previously. So that's really looking at that available credit you're using. When the credit that's available to you decreases because you've used a portion of it and now owe money, your scores could drop. They're also going to look at the length of your credit history. So that's going to track how long you've had credit accounts. So this kind of plays into Sarah's question here. It could change your score, but a long credit history kind of provides this strong evidence to creditors of how you use credit and the patterns of your payment behavior. So the longer the history, oftentimes the more positive the effect on your score is. They're also going to look at types of credit used. We're considering, whether or not you've got revolving credit, such as credit cards, and other types of credit, such as like a mortgage payment or an auto loan that you're paying in installments, whether or not those are in good standing. Oftentimes, it's considered a good thing to have a mix of credit. Okay, so talking about those installment loans, as well as some of that revolving credit. So kind of having a mix. But also keeping in mind, we don't want too many credit cards or too many accounts. And then finally, we're going to look at new credits, and that's being tracked by measuring those credit inquiries that are made about you by creditors. So if there's too many inquiries, it might signal that you have a high demand for credit. And because of that, it could be an indicator of risk. So your scores could drop. Now, again, going back to those soft inquiries, just remember, if you're reviewing your report, that's a soft inquiry and that will not affect your credit score at all. So if you kind of look at this pie chart here, looking at that payment history and amounts owed, just those two categories make up about 65% of what determines your FICO score. So making sure you're paying, making payments on time, making sure that your credit utilization isn't too high is going to be important when thinking about your credit score. So I know I mentioned this a couple of times here. Oh, Emmett, great question. Let me tell you more. Credit utilization. So this is a part of the credit scoring kind of formula that might penalize you for using too much of the credit you have available to you. So amount of credit you're using compared to the amount you've been given. So a lot of times experts advise that you keep your credit, the use of your credit, excuse me, to no more than 30% of your total credit limit on your revolving accounts, okay? So an example here is that you have $5,000 of total available credit and you currently have $35 or $3,500 of that being charged, right? So you are using approximately 70% of your credit. Again, you want to try to keep that under 30 if you can. So let's do a little breakdown of the FICO score. So the FICO score goes up to 850. We've got several categories here. So if you've got a score of less than 580, this is just kind of telling us that your score is pretty far below the average score of US consumers. And this is really just telling lenders that you might be a risk. If you move into the fair category, we're looking at a score of 580 to 669. And while this is below average, oftentimes lenders will still approve loans with this score. Then we move into the 670 to 739 range. And this is either near or slightly above the average of US consumers. And most lenders are going to consider this a good score when you're in that 670 to 739 category. Now, interestingly enough, the national average currently kind of hovers around that 714. Minnesota performs a little bit better than that, which I found interesting. Their average is about 742. So they are just kind of sneaking into that very good category of the FICO breakdown. And so that credit score level is really saying you're above average, and it's demonstrating that you are very dependable, which is great. So again, that's the average of where Minnesotans are falling into line. Now, if you are at 800 plus, that is saying you are exceptional with managing your credit, and you're demonstrating to lenders that you are a really, really low risk. When I think about the FICO score breakdown, regardless of where you are, just know that, you know, if you're hitting lower than what you would want to be, it's not too late. You can still work on building that credit up, and Sarah is going to touch on that in a bit here. But there's always room for improvement and then maintenance, kind of when you hit that stage of where you're really feeling comfortable, really feeling good. So to talk a little bit more about credit scores and things that might affect your credit score, we thought we would do a little game, fact or myth. Okay, so you're going to have to play along with us here in this next section just a bit. But we want you to add into the chat here. So I'm going to propose a question to you, and I want you to add in the chat whether or not you think this is going to be a fact or a myth. So fact or myth, your credit score drops if you check your own credit. We have given you this answer. Okay, I'm seeing lots of things in here. Okay, it is a myth. So remember, checking your own credit is going to be a soft inquiry. Okay, and oftentimes this is kind of one of those misconceptions that typically fools people. But again, viewing your own credit report as a soft inquiry does not change your score one way or another. Hard inquiries can affect or lower your score just a little bit because that's saying you're applying for credit. Okay, fact or myth. Closing old accounts helps your credit score. This is also a myth. Yeah, I know Sarah touched on this a little bit already. So this myth kind of advocates that closing old accounts and inactive accounts is going to hike up your score. That's not necessarily true. This could inadvertently have that opposite effect and lower your credit score because your credit history appears shorter. But if you don't trust yourself to put a card away in a safe place or not use it, then it might mean, hey, you do want to cancel it. So this is going to depend on the person, but it can move the needle either way.
When it could also impact that total credit utilization, right?
Oh,
so if you
absolutely.
close 2 or 3 credit cards, all of a sudden your potential limit has shrunk. So it might bump up your above that 30%. So
that's a great point.
But also if folks are sitting there with a fistful or a wallet full, purse full of credit cards and you're not using very many, I would slowly close a few over several months, and you'll rebound on that as well.
Absolutely. That's been my thing. I'm really been kicking around which accounts I don't need anymore, which ones I'm ready to sunset. Okay, next one here. Paying off a negative record means it's taken off your credit report. Paying off a negative record means it's taken off your credit report. I think we're catching up. Okay. So myth again. So paying off that negative record does not mean it's taken off your credit report. Generally, those negative records, such as like a collection or late payments, are still going to remain on there for up to 7 years from the date of that first delinquency. But paying off the account sooner, instead of it being deleted, it might just have a listing on there that says paid. Okay, so of course it's smart to pay off your debts to both reduce that total amount of debt you owe and to show your willingness to pay your obligations. But just know that you should expect that negative record to stay on your report until it's past that 7 years. Then it can be purged.
Great. Well, I think we're going to have just a couple more myths and fact items here. Co-signing means you are responsible for the account. Fact or myth? I'm seeing some facts here. A couple myths. We are going to go with fact on this one. When you co-sign a loan, you need to be prepared to take over payments for the individual you co-signed for if they fail to do that. So you are held legally responsible for that account. Activity on that joint account is displayed on the credit reports of both people. So again, if you co-sign a friend's auto loan or even a son or daughter's student loan, and that person doesn't make the payments, your credit profile will be hurt, and vice versa. So the only way to end the dual liability is to have just one party refinance that loan or persuade the creditor to formally take you off that account. So be prepared to pick that up if the first person doesn't make payments. Fact or myth, paying off a debt boosts your score by 50 points. Okay, I'm seeing myth, myth, myth. Emmett, we'll get back to your question here in a minute after this one. Okay, I'm seeing primarily myths here, and you are all correct. It is a myth. So credit scores are calculated using, again, that complex formula that Nikki spoke of earlier. And it's nearly impossible to calculate the difference changing one factor might make. You know, we can say, oh, that'll help or that might hurt, but it's just really wise to pay your bills on time, you know, work to lower your debts and again, correct any errors that are happening on those credit reports. So a proven record of sound financial behavior in time will have the most significant impact on your score. Emmett had a question. What if you have just your name on another person's account? So if you perhaps are an authorized user, but not a what do they call it, Nikki? A co-owner. If you're not one of the main people on the accounts as an authorized user, you are not going to be impacted by the good or bad behavior of the person. Good question. All right, so how to build your credit? And someone had asked that earlier. Sometimes it's just as bad to have no credit as it is to have bad credit. So if you need to build your credit, and perhaps if you don't qualify for a credit card, go to your financial institution and ask about a secured credit card. I was working with a young man recently, and this is what he had to do because he didn't qualify. He went to a few of his favorite stores and applied, and he got rejected. And so he ended up going to his financial institution and got a secured credit card. And what that means is that he had to put $500 into an account that he could not touch once he put it in there. They gave him a credit card with a $500 limit. So they were 100% covered. If he didn't make payments, they had the $500 sitting there. So he used the credit card for gas and groceries, and pretty much he paid it off in full every month. And after 6 or 9 months, he got a nice little letter from the financial institution with a check for his original $500 that he had demonstrated good behavior in demonstrating responsibility and using and paying that credit card. So hopefully you'll have a relationship with a financial institution, your bank or your credit union, that you can secure those. Using retail store cards, many gas stations, department stores, retail chains, those types of places, it may be easier to get credit cards than other places. So you could check on those and see if that works. Now, we do have the terminology here, Nikki, on become an authorized user. So to be an authorized user, are they reporting that on the individual's account? Can you help me with that one, Nikki?
I thought so, but you know what? Why don't you keep going, Sarah, and I'll come
Okay.
back to that. I'll double check.
Yep, let's double check that. So financial institutions, typically like credit unions, will do that secured account that we talked about. And they may even be able to give you like a small loan, or where, so similar to the secured credit card, where you would have a secured loan, for example, and you make payments to them for a couple $100 up to $1,000, so that they can report that behavior of making payments. And so seeking out these opportunities is really important. Sometimes when I work with folks, and not so much anymore as in years past, but if they had loans with the small bank in their rural community, not everybody reports to the credit bureau. So I've had people say, I've had car loans with my bank, and they never reported it. So it's important to know if your financial institution is reporting those payments, so that your good behavior is being documented and reflected on your credit report.
I've got a response for you, Sarah.
Okay, great. Lauren has one too. Let's see what you say, and then we'll compare that to Lauren's comment.
Let's see. You're not legally responsible for making the payments, but you can reap the benefits of the credit from that author, or excuse me, from the account owner.
Okay, and so Lauren's saying an authorized user typically just has permission to use the card. If they are joint on a card, then they are equally responsible. But you're saying the authorized user also can reap some benefits.
Correct.
Okay, so we're gonna, thanks, Nikki, for putting that link in there. Definitely, if you are an authorized user or a joint owner of an account, ask those financial institutions how that is reflected on each person's credit report, so that you're sure of what's happening there. Okay, so there are some credit cards, or you can use credit cards as a tool to build credit history and your score and your report. And just like the little pie chart that Nikki had earlier, pay your bills consistently on time, stay well below that credit limit, avoid any unnecessary fees, so late fees, over the limit fees, that type of thing. Pay more than the minimum payment is always good practice. And to build credit, have at least 3 active lines of credit. And if you don't have any at this point, oh, thanks, Nikki, for forwarding me here. Have at least 1, work to 2. We're searching for that healthy mix. So it might be a mortgage and a credit card and a student loan, or swap one of those out for a car payment. So having that healthy mix there. All right. So if you don't have credit cards, student loans are going to document behavior. Those credit builder loans, so similar to that secured credit card, a credit builder loan, same kind of concept, being a co-signer. And sometimes lenders will look towards those less traditional payment data. So if you can get a documentation from a landlord or perhaps a utility company to document that behavior. All right, so how to rebuild your credit? Clean up the past, right? Take care of the dirty laundry in the past. Pay off those collections. Take care of any errors. And then the positive actions, again, I feel like a broken record, but it's pay your bills on time, keep the balances low, apply for credit only as needed, and check your credit reports regularly and make sure there's no mistakes happening there. So we've got a question for you. If you could add in the chat, what steps are you planning to take to rebuild your credit? Share some thoughts there, and I'm going to go to the next couple slides here because we are about done. We used a lot of different resources, the MyFICO website, the 3 main credit bureaus, the Consumer Financial Protection Bureau have lots of great resources. Yes, keep those actions coming in the chat there. If you need a certificate of participation, complete the evaluation, and that link is going to be on the next slide. Also, if you are from the University of Minnesota and you've got the university health insurance and you are seeking well-being points, yes, complete the evaluation. And here's the evaluation link, and Diane's going to throw that in the chat, and we will also be doing a follow-up email for folks. To all the participants, and we'll include this link in there, but there is a question on the first question is, which webinar did you participate in? So select the credit scores and reports. And then towards the end of the evaluation, and it's pretty short, it's going to ask, do you need a certificate or not? And if you say yes, you'll put in your name and email, and it'll email it right to you. And it'll also ask if you are interested in the well-being points, and it'll give you a link to access those. So we'll do a follow-up email. And then about a month or so at the end of this series, we'll be doing a follow-up email. We'll be including a playlist with links to all the recordings in this series. And we'll also have a few questions there that we're going to ask you. Did you do what you were thinking you were going to do? All right. A few upcoming webinars. We have some of our Spanish speaking colleagues are doing some webinars related to kids and the transfer of non-title property, making sense of it all. That's we've got one left coming up in June on saving money while feeding your family, a few on finding balance, some related to housing. We have a book club starting tomorrow if you're interested in housing. And then this extension.umn.edu /courses and events. You can go there and find courses and events from all of our centers and extension. Whew. We do encourage you to get social with us. We'll include these links in the follow-up email as well. So check us out on Facebook and Twitter and LinkedIn. But the bottom piece, we encourage folks to subscribe to our Family News e-newsletter so you can keep up to date on those things. Thank you for joining us today. Nikki and I will hang out here for a little bit. If Diane, I think you can stop the recording, and if folks have questions, they can definitely